Florida's housing market is undergoing a structural collapse in 2025. This is not a forecast or speculation, it is a reality documented by verifiable data. The state is contending with the largest housing inventory in its history, insurance costs that have rendered ownership unaffordable for a significant portion of the population, and a documented decline in buyer demand. What was once America's most desirable real estate destination is now defined by a cascade of interconnected crises. This analysis will break down the data sets that reveal the true scale of Florida's market failure. For homeowners, investors, and potential buyers, understanding these numbers is critical to navigating the significant risks ahead. Welcome to Housing Intel, where we deliver data-driven market intelligence. Subscribe now to stay ahead of market-moving trends. The most immediate indicator of the crisis is the state's housing supply. As of 2025, Florida has over 180,000 homes listed for sale. This figure represents the highest active inventory ever recorded in the state. Data from the Florida Realtors Association confirms a 28.8% year-over-year increase in listings from May 2024 to May 2025. This surge is not a sign of a healthy, dynamic market. It is evidence of a glut where supply has catastrophically outpaced demand. Before a recent minor decline, inventory had risen for 110 consecutive weeks. A deeper analysis of this inventory reveals critical weaknesses in specific market segments. Statewide, the supply of single-family homes sits at approximately 5.6 months, a level that already indicates a buyer's market. However, the condominium and townhouse sector is in a far more precarious position, with a staggering 10.3 months of supply. This severe oversupply means that for every condo sold, more than 10 are sitting vacant, placing immense downward pressure on prices and creating significant financial strain for owners and condo associations. Recent declines in overall inventory have been attributed not to a surge in sales, but to delistings, sellers removing their properties from the market out of frustration, which artificially masks the true depth of the oversupply. The second pillar of this collapse is the state's dysfunctional insurance market. The cost of homeowners insurance has become the single greatest threat to housing affordability in Florida. In Miami-Dade County, average annual premiums have surged to $14,140, a 322% increase compared to 2022 levels. This is not an isolated issue. Jacksonville has seen premiums rise by 226%, while Tampa has experienced a 213% increase. To put this in perspective, the average cost of homeowners insurance in Florida is now 262% higher than the national average. These costs are driven by fundamental risks. A string of costly hurricanes and flooding events has led multiple national insurance carriers to exit the Florida market entirely. This has reduced competition and forced hundreds of thousands of homeowners into the state-run insurer of last resort, which offers coverage at even more prohibitive rates. On top of standard policies, flood insurance has become an additional crippling expense. In designated flood zones, annual flood insurance premiums can add another $8,000 to $12,000 to a homeowner's expenses. The cumulative financial burden is unsustainable. Reports indicate that many Florida households are now allocating over 40% of their total income just to cover their mortgage, property taxes, and insurance. This is a formula for financial failure. This affordability crisis has created a visible and growing trend in the market: the rise of as-is and cash-only sales. In coastal communities and flood-prone neighborhoods, a significant percentage of property listings now carry this distressed language. These are not standard real estate transactions. They represent a shadow market where sellers are forced to liquidate damaged or uninsurable properties. Conventional mortgage financing is often impossible for these homes. Lenders are unwilling to underwrite loans for properties that cannot secure adequate insurance coverage or that fail to meet appraisal standards due to flood damage. As a result, the only viable buyers are institutional investors or cash-rich individuals who can absorb the risk. This creates a two-tiered market, one for standard, financeable homes and a separate, deeply discounted market for distressed assets. This trend actively suppresses property values in affected neighborhoods, as each as-is sale sets a new, lower comparable price for the entire area. Compounding the housing-specific issues is a slowdown in Florida's vital tourism sector. Canadian visitors, who represent one of the largest and most consistent international demographics, have declined significantly. Data from early 2025 shows a drop ranging from 3.4% to as high as 20%, depending on the source and measurement period. This decline has a direct and immediate impact on the state's economy. First, it weakens the short-term rental market. Investment properties purchased with the expectation of generating income from tourists become less viable, prompting more owners to sell into an already saturated market. Second, lower tourism leads to reduced hotel occupancy and less spending at local businesses, which in turn can lead to job losses and further dampen local economic confidence and housing demand. This creates a negative feedback loop where a decline in one sector amplifies the crisis in another. In response to these dire market conditions, home builders have resorted to aggressive incentives. Price cuts ranging from $40,000 to $100,000 on new construction are becoming common. Builders are also offering to cover closing costs, provide free upgrades valued at tens of thousands of dollars, and buy down mortgage rates to make monthly payments more manageable. While these strategies aim to stimulate sales, they also have the unintended consequence of dragging down the value of existing homes in the surrounding area, further fueling the downward price spiral. Industry analysts widely agree that this is not a cyclical market correction, but a long-term structural realignment. The fundamental drivers, climate risk, insurance market failure, and economic shifts, are not temporary. Therefore, a return to the market conditions of the early 2020s is not anticipated. Looking forward, several key indicators will signal the market's trajectory: the rate of foreclosures, the financial health of condo associations facing rising costs and special assessments for repairs, and the continued trend in active inventory levels. The data paints a clear picture of a market in profound distress. Florida's real estate sector is being reshaped by forces that are here to stay. For anyone with a stake in this market, navigating the months and years ahead will require access to clear, unbiased, and data-driven intelligence. If this analysis provided you with valuable insight, subscribe to Housing Intel and enable notifications. We deliver the factual analysis you need to make informed decisions. Now, we want to hear from you. Are you buying, selling, or waiting on the sidelines in the Florida market? Share your strategy and observations in the comments below.